Hello, welcome back. Today we're taking a look at InMode. This is a company that was suggested by one of our subscribers. And I'm looking here that they specialize in proprietary radio frequency assisted lipolysis and things of that sort that work on radio frequencies. Now, I always took these things with a grain of salt, but I hope they have been proven medically. You can always take a closer look at the actual proofs that the company has provided and what they are doing in terms of research. But today we're going to be taking a look at the financials. With this kind of medical companies, it's always important to make sure that they have products that are, medically assured, products that have met their burden of proof pretty much, and make sure that you're not going to be getting some sort of a massive decline because of a legal issue or something going wrong, really. Especially when they have a short line of products, the more diversified they are, the better it is for medical companies. Now, we're going to take a look at the financials of the company, a very beaten down company. You will see here that it is down 74%, absolutely annihilated recently. And its 1 year high has been $99, currently sitting at 26 over here. And the P ratio now is sitting at 13.6, down quite some from its previous highs. And price to free cash flow ratio also down. Now a lot of dilution here going on. And I'm assuming as the company's stock price does go down now, if we take a look at the 1 year, as it starts to go down back in November pretty much, this is when the company actually stopped selling a little bit over here. This is when they kind of started to normalize the selling, because before that they were going bananas, ballistic with selling, again because of the stock price, it was going higher. So this is something that I don't like. And not many liabilities, though, when you compare to the free cash flow. That's a good thing, of course. And good growth in terms of revenue, net income here, free cash flow, total equity, looking pretty good. Okay. And debt to equity ratio that is very low here. We're going to examine the details, but also great returns as well. And a great net income margin. Good stuff here for the company in terms of its financials. Yeah, very impressive growth margin, income margin here, and very impressive returns as well. Now let's take a little bit of a closer look at the financial statements, see a few things in detail here. From 53 million to 357 million, a pretty steep increase in terms of revenue and revenue growth here, so that's nice to see. And if we go down, you will see that the net income of the company has been increasing nicely as well. Another big thing to see for a company of this sort. Seems that they are doing better here over the years. Okay, the balance sheet of the company must have quite a few assets here, and that would only make sense based on how much selling they have been doing in terms of their own stock. From 19 million to 415 million over here, and you will see that the additional paid-in capital has been increasing lately, so selling quite a lot of stock to shareholders that want to acquire some. So the company is doing well in terms of that, but remember that this was funded for the most part by shareholders. This is a large chunk of the total equity here, and it has been happening in the last 3 years. So the cash flow statement. The company is net income positive, which is always a great thing to see. And when you derive the cash flow provided by operating activities, you are getting a very nice figure here that also keeps increasing. I like to see that. And in terms of investing activities, the company is investing normally here, investing some things, purchasing investment, selling some investments as well, very normal things, and paying back some debt over here, which is another nice thing to see. The company has virtually zero debt, which is weird. I mean, I would expect them to have a little bit more. They have, practically speaking, zero debt here, it looks like, at least based on the figures that we saw earlier, because it was like 0 point something of their free cash flow, so their total liabilities must have been pretty low. Let me check again. Total liabilities here were 62 million. They can use their free cash flow just to pay it today, like very easily. Half of the free cash flow actually, not even. So very little liabilities. That's good. That's a good thing, and keeps increasing as well. Okay, let's take a look at our stock evaluation tool. See if this company is undervalued or not. It certainly does look like this could be an interesting buy here. 5-year average in terms of revenue growth has been increasing. It's pretty high. Of course, we cannot use these values. I typically will almost never go more than like 22-23%, and that would be in cases where the company has extreme growth. This company has extreme growth, so I will go high. I will go 18, 20, and 22 and see what we get out of this one. The net income margins very similar every year, especially the last 3 years. So we're gonna go 35, and then go 40 and 45. Free cash flow margin, again, pretty similar. These are good things to see, very, very good things for the company. 100, 105, and 110. And 13% is the annual return that I typically want to be making, because I can make 10% out of an S&P 500 ETF, so I need to be making a little bit more with a single stock. And I hit calculate. And yeah, as expected, we are seeing that the company's max price to pay, even for our low estimates here, is sitting at $42. It has been extremely battered down lately. It has been annihilated. And right now it's sitting at a price that looks promising. I kind of like it. It's $26. And our low estimate is 42 and our high is at 70. So this is a company that definitely looks like a buy, and I'm seeing that the financials agree with that. The only thing that I have a concern about is the dilution here, but probably that won't be continuing, at least for the time being, because the stock has been going down quite a while. And yeah, I don't think they would want to continue selling here. It kind of shows in the trend as well. It kind of flattens lately a little bit. So yeah, I would expect them to stop the issuance of shares and just work on their operations. And yeah, their growth seems promising here. Not much debt, virtually no debt, practically speaking, and great returns. This is looking like a very, very interesting company to add to a portfolio, especially as it's falling down off a cliff, really. So yeah, I'd definitely look into adding a little bit of this one in my portfolio. And thank you for watching the video. I hope you enjoyed this one, and I'll see you in the next one. Please remember to leave a like and subscribe if you like this kind of content, and I'll see you soon. Bye bye.